Welcome to Season 2 of the Generational Dental Wealth Show. Season 2 is all about increasing dental financial IQ. We do record these live in studio at Team Studios, so if you want to see the video format of this show, go ahead to Spotify or YouTube.
Before we hop into today's episode, we wanted to share that this is not legal or financial advice. The thoughts that we share here are our own, and these are for educational purposes only. Kingsley is my CPA. He gives me financial advice. Please seek or solicit the help of your team and your financial advisors for your financial future.
For this episode, we're on the road to Las Vegas, Nevada. The NDA National Dental Association Conference invited us to do a live presentation talking about building generational dental wealth with a tax mindset. We know that you will get as much value out of it as we enjoyed giving. This is part 2 of a 2-part series. So if you haven't watched part 1, go back and watch it and join us for part 2. Let's hop into it.
So, broad strokes here, the magic of accelerated depreciation. Too much to go into it in one talk, but for the most part, depreciation is what we like as accountants, right? Accountants, we think we're so special. We're not that special. We like to make up all these fancy terms. All it means is spreading the cost of an asset over its useful life, or over the life that the IRS says is how long it's supposed to be around. This client, they came in, like I said, they wanted to get more equipment and furniture. They were interested in getting a new CBCT machine. So typically, if you don't accelerate it, you have to spread that cost over typically 5 to 7 years, right? Equipment and machinery is typically 5 to 7 years. So in this example, in year 1, which would be this year, they would only get a $10,000 tax deduction. We wanted to say, you know what, and this client was saying, no, I want to wait a few years, I want to do this, I want to do that. We're like, well, if you're going to go ahead and buy it, go ahead and buy it now. Let's go ahead and get into, play now so that we can take advantage of this year for tax purposes. So long story short, what we went ahead and did was we went ahead and agreed with him. He was going to go ahead and get it in, and we got it in literally the day, like pretty much the day before New Year's. So we got it placed in the service the day before New Year's. He was able to take advantage of this tax deduction. So long story short, he got a $50,000 tax deduction in year 1. Cool. Next one here, like I said, broad strokes, cost segregation study. Biggest thing with cost segregation study, what we're trying to do as your accountant, as your CPA, is we want to put and like I said, he owned his practice, right? So he owned the building, and he owned his practice. So when owning a building, what happens is when you purchase a building, you purchase all of the components, like the room we're in, right? There's a structural component to this, the things that we don't see. And then there's like the things that you do see, right? Like the light fixtures, the equipment in here, the chairs in here. But when you purchase typically a property, you're purchasing all of the components with it. What ends up happening, that big purchase price is not allocated into buckets. So what a cost segregation study is, it allows us to put things into their buckets. And the reason that's so important is because the IRS has 2 different ways they look at short life assets versus long life assets. Short life assets, like I said, can include furniture and fixtures, refrigerators, carpeting, signs, right? The signs on the top of your building, as well as like plumbing, office furniture, etc. That's typically taken over 5, 7, or 15 years. Those type of costs, we can, doing some accelerated methods, we can capture those costs all in year 1, or we can just capture them really fast. So $1 today is worth $1 tomorrow. That's probably what most of us, or some of us might have heard. So we want to save as many dollars today, even if we pay the cost a little bit more tomorrow, because $1 today is better than $1 tomorrow. Long story short, the biggest thing to know with cost segregation studies, residential properties, so if you're into any residential real estate, typically is over 27.5 years. But commercial, right, just like many dental practice buildings, typically taking over 39 years. I'll be honest, I want to get most of us passively earning money way before that period. So we don't want to be spreading these costs over 40 years, right? We want to get these costs as fast as possible to get that money into your pocket. So in general, there are qualified professionals that perform these studies. They're anywhere between like $3,000 to $5,000 for a decent one. For the most part, A lot of these studies are conducted by either CPAs, engineers, just people who are qualified to go ahead and conduct these studies, because they have to go in and they have to identify within this property what is what, right? So they have to know what they're looking at so that they can go ahead and give you that study. It's literally a PDF with a printout of all the different things that they identified in the building and what bucket they fall into. What I like to do as well, I don't recommend these studies if it's not going to pay back what you spent on doing it, right? If you're only going to be, if you're in year 20 of owning your practice and you've used up most of your depreciation, then you may not even be able to take advantage of something like this, then I just recommend don't even do it, because you might end up putting $5,000 down. Your tax benefit may not be as beneficial. Cool. So this one, I'll be honest, I went back and forth with the client a few times. I gave him my take on it. He didn't listen. It's okay. He went ahead and got that Cybertruck. It's all good. I want my clients to live a little bit. I don't want to be the bad guy all the time. But anyways, next thing we took a look at is leveraging his personal vehicle, or leveraging his business vehicle, right? What we wanted to do was take a look at both options, right? Because a lot of times the IRS gives you two options. They give you the simple one, and they give you the one that's a lot more work, but could be a bigger deduction for you. The two primary methods to consider with leveraging a business vehicle would be mileage method or actual method. Typically, every year, mileage rates do change. This year, 2024, is 67 cents. So for the most part, unless this dentist had a long commute, or unless they were a 1099 travel dentist that did multiple offices in a week, may not be the 100% best way to optimize using the auto. But in general, let's say that this dentist drove 10,000 miles per year for getting around town for the business, et cetera, et cetera. You multiply that 10,000 miles by 67 cents. Tax deduction would be, see, made a typo there. Be 6,700. Excuse me, 6,700 there. Pretty straightforward. The other one here is the actual expense method. So the good thing about this one, like we talked about earlier, depreciation. He's able to take depreciation on his vehicle, right? Typically vehicles over 5 years. And what we're able to do is we're able to not only take the depreciation expense on a vehicle, but we're able to take the actual expenses. So what was the car maintenance? What were the, what's some other deductions out there? What was the oil changes, et cetera, et cetera. All of the expenses associated with the vehicle for the year. We're able to say, okay, John, how much did you use this vehicle for business purposes? He may say 25%, he may say 30%, he may know best. But in general, we're able to take all of those actual expenses, multiply by how much he used it for business, and take that as a tax deduction. So really, really powerful expense here, and I've seen this really help out a lot of our dentists. A lot of these concepts do have to do with if you can, even if it's not a lot, if you can get some type of 1099 income into your pocket. Now, obviously, I know many people have different situations. What I've seen, and in my experience, have plenty of dentists, they either own a practice, and if they don't, if they're an associate, then they at least do one or two days in the month to get some type of 1099 income. Then they unlock pretty much everything that we're talking about. Now, on the last slide, I will talk specific tax strategies that even anybody can take, whether they're doing any 1099 or not. But in general, we're headed towards whether that person's a 1099 contractor or own a practice. But like I said, just stick around with me. I have some stuff for you at the end. So in general, say you're making about $180,000 at your associate job, W-2. If you have enough expenses that create a loss when you're doing a 1099 job, so let's say you make another $50,000 on the road, let's say you have $75,000 in expenses, that $25,000 loss can be taken against that $180,000 W-2 income. So it can reduce your income, your taxable income, and get you a refund, right? If you've been owing every year, or your refund hasn't been that glorious, it could create a situation where it can really help you out a lot. Just a few more here. So obviously this is for illustrative purposes only. Tax code, I promise you, I sit here for 5 hours trying to go through every detail. But for the most part, right, before tax strategies, like we looked at his tax projection, gross income was about $300,000. He wasn't really getting any tax deductions, right? He was coming in, he was writing that check. IRS is getting they bid saying thank you. And honestly, in my opinion, he was leaving the IRS a bonus, right? We don't want to leave the IRS any bonus. There's nothing more patriotic. There's nothing the IRS does not think it's more patriotic to pay more in taxes, right? They say pay what you're legally obligated to pay and not a penny more, right? That's been proved case by case, and even the IRS has said that. So we don't want to leave the IRS any any bonuses this year, right? So no tax deductions for them. That made his taxable income still to $300,000. Obviously, tax bracket, like I said, it's a little funky the way we calculate it, but let's just say effective rate was about 35%. His tax bill due, like I said at the beginning, was about $105,000 there. Now, after tax strategies, we're able to take a lot of the different deductions here. Like I said, those coupons, right? In my mind, I like to think about coupons, right? You go to the store, you have this, you're at Walmart buying a new TV, and then you get all these little coupons that can add up, that can reduce the cost of that TV, right? So we already talked about Augusta Roll, Home Office, S Corp, Kids on Payroll, Vehicle, CBT machine, which can include any type of equipment, right? Cost seg study. When all that added up to about tax deductions about 194. Like I said, this real client came in. We were able to get his taxable income down to about 106,000. And like I said, for tax purposes, we want to look like we don't got it, right? For tax purposes, we don't look like we don't got it, right? And that's the point of tax deductions. So taxable income, like I said, against his tax rate of about 24%, his tax bill due was about 25,000. Now, that's a swing of about $80,000 cash back into his pockets that he didn't have to write the IRS. Before we hop really into a lot of these strategies, the first thing we do, especially during our tax projections, we like to ask, like, do you have any major financing coming up? Are you purchasing a new practice? Are you purchasing a new vehicle? Are you purchasing a new home? And if that's the case, we don't want to be as aggressive. This is pretty much an aggressive scenario, right? If we're trying to get things down as better as possible, add backs are super important, and all that is, right? Depreciation can be an add back, like amortization is another accounting word out there. Even like doctor payroll, right? I don't know if anybody's purchased a practice, but anytime you purchase a practice, it's millions, it's a lot of add backs. And even like the money that you're paying yourself out of your practice, the profit and loss might say that that's an expense coming out to practice, but typically underwriter, especially like to his point, like I said, if they have an accounting background, would clearly understand that that's money going from one hand to another. It's not a true expense. It's kind of what I'm saying there. So anyways, last few slides here. In general, this is, like I said, for illustrative purposes, kind of goes to the next point of what I want to say. Kind of how we started the presentation here. Taxes are your biggest single expense, and it's the biggest either accelerator or inhibitor of your wealth. And to me, it's not just because of the one-time tax bill. It's because of opportunity cost, right? Time value of money, right? And this is just, like I said, a very conservative, if you just putting some of those tax savings away, right, at a modest 6% rate, like this isn't even a crazy rate. This is like high yields plus 1%, right? These high yields are getting close to 6% these days, completely safe. Your money is not going to be affected by ups and downs of the market. Something like a high yield savings account. In general, over 25,000 over the next 35 years, each year putting away some of those tax savings, that's a good retirement right there. I mean, $3 million, right? That's an extreme situation, but in general, it can be done. And I've seen it being done, and we have clients that do it every day. So in general, the next step is really, and how we like to look at it, is speaking, especially with our clients, and seeing how we can now focus on asset accumulation. Like I said, cash flowing and appreciating assets, and we do have asset accumulation experts that we like to go ahead and hand that off to. So in general, last couple slides here, it kind of goes to your point earlier. There were a few other tax strategies that we didn't get to today, but just a few more to consider, and some of these do have to do with if you're just, like I said, receiving W-2 income, you can implement some of these. There's something called a spousal, and to my real estate professional back then, shout out to you, a spousal rep status, right? Spousal real estate professional status. What it does, long story short, it allows a lot of your tax deductions that are, tax losses that are passive, right? If you are in real estate and you have these passive losses, it allows it to now come active losses and come against your active income, like your W-2 income, your practice income. So it just changes the game there. Spousal 401k, you can hire a spouse. Like I said, I come from family businesses where we hire spouses here. So you can hire a spouse where they can now be on payroll and get all of their money just straight into their 401k. So they receive all that money into their 401k, they don't pay any taxes on that income because that's deferred income, and the practice receives a tax deduction. That's a huge one we have. So this client, he had a Tesla Cybertruck. He gets the EV credit up to about $7,500. Huge tax credit. Help plenty of clients do that. High yield saving accounts, HSAs, or that's I put high yields, but HSAs are a little bit different. But HSAs in general, they will help you put some money away for obviously like medical expenses. You get a tax deduction today. It grows tax-free as well, and when you take it out, you don't have to pay any taxes on it. So it's like a three-way mega tax benefit there. So in general, itemized deductions, this is my point earlier, even if you're an employee, associate, itemized deductions are one of the greatest ways to really, really help you out on tax time. So that includes like mortgage interest, property tax deductions, charitable contributions, even like the state taxes that you've already paid on your W-2, it includes that as well. And there's pretty much a list of, there's so many different itemized deductions out there that can really help you. IRA, we've heard of it, there are income limits. So like I said, it may or may not apply, but in general, IRAs are another really good one out there. 529 college savings plan. Like I said, they had 2 kids, really young, so not a terrible idea to look into a 529. It's really, really big on the tax saving side. S Corp accountable plan. All this is us trying to come up with a plan for your S Corp so we can put things like cell phone bill, things like any type of kind of personal expenses in nature, how we can kind of create a plan for your business to reimburse you back for those expenses so your business can get that tax deduction and you can get that income tax-free, right? And then the last one here, he said that he loved to travel. Travel deductions, like we're all here today, right? Depending on how you receive your income, you could have deducted the cost of this trip, right? Your flight, your hotel, right? This is you all investing into your craft, right? Into dentistry, into your profession. So that it is a legitimate travel deduction. You're able not even deduct the cost of attending the seminar, but also the cost of getting here and the cost of lodging, et cetera, depending on how you receive your income. So just some cool ones right here that, like I said, can really change the game.